What to expect at a critical market point. End of a Wave 2 rally. I'm Bob Stokes with Elliott Wave International. The great game of Wall Street, where huge amounts of money are at stake every trading day. Many speculators play this game by watching for events outside of the stock market that they believe will trigger the next big move in prices. However, the real driver of all those green up arrows and red down arrows is nothing more or less than investor psychology. This famous Cows cartoon sums it up perfectly. First investor, I've got a stock here that could really excel. Second investor, really excel? Fourth investor, sell? And the crowd goes, sell, sell, sell. First investor again, this is madness. I can't take it anymore. Goodbye. Second investor, goodbye. Third investor, buy. And the crowd goes, buy, buy, buy. As random and unpredictable as this cartoon makes it look, EWI's research reveals that investor psychology actually goes through similar phases during every market cycle. So if you know the current psychological phase of the market, you can make a high confidence prediction about the next phase. This leads us to what we call Elliott waves, which are simply reflections of these psychological phases. In other words, each wave represents a set of investor attitudes, sentiments, and behaviors during a specific phase of the market cycle. The Wall Street classic book, Elliott Wave Principle, Key to Market Behavior by Frost and Prechter states, a knowledge of wave personality can be invaluable. Recognizing the character of a single wave can often allow you to interpret correctly the complexities of a larger pattern. Specifically, EWI's analysts have observed that the stock market trend develops in 5 waves, while the reaction against it develops in 3 waves. So in a bull market, expect 5 waves up, followed by a downward move of 3 waves. In a bear market, expect 5 waves down, with the upward correction occurring in 3 waves. With all of the above in mind, consider these recent expressions of investor psychology. The news excerpts were compiled by the editors of our Elliott Wave Financial Forecast and shown in the March issue. Do these positive investor sentiments seem odd in the face of the stock market volatility that occurred after the January 26 Dow Industrials high? Well, there is an explanation. The March financial forecast said, the bullish response to the market's decline is exactly what the wave principle suggests should occur at a trend reversal. Near the end of a second wave rally in a bear market, Elliott Wave Principle by Frost and Prechter states that investors are thoroughly convinced that the bull market is back to stay. In the current case, most investors are convinced that the bull market never went away. Since that analysis published, the Dow's Elliott wave pattern has provided our analysts with even more clues about the stock market's next big move.